You're listening to Conquering Retirement with Annuity FY. Real strategies, real stories, no sales pitch. Join Tom Hamlin and his expert guests so that you can make smarter moves faster. Hit that subscribe button and let's conquer retirement together.
I'm going to see what everyone thinks of my hat at Annuity FYI today. That's kind of the plan. You know, just a little bit about me. I usually wear this every day outside of work. So I thought, why not do it today? Let's go. Oh,
Hammy, you're not wearing that hat, are you?
what do you mean? I've worn this on every episode already.
Have not. It looks like Little Red Riding Hood.
Oh my gosh. Meg, you look wonderful. And she said nothing about me. About my hat.
Hold on.
Hi, Meg.
Hey, sorry, I was having tech issues and I was trying to get the lighting.
Someone looks fancy today.
Thank you.
All right, welcome everyone. I'm glad to have you here, Tom Hamlin. I don't know what more I can say about you other than you are the man, the myth, the legend. Tom, you know, I say this every episode, but I can't say it enough. You've been in the industry for 35 years. Along with that, you also have experience in real estate and other ventures. So you have a lot of knowledge just overall. I'm so happy to be able to work with you every day. I also have Brian Hamlin here, Tom's protege, and his son, Brian, is already an expert in the industry. I get to work with you every day, Brian, which I love. And yeah, I'm really excited to have you here again. My name is Meg Odermatt. I have been working with Tom for over a decade now, and I love what I do because I get to work with experts in the industry every single day. Part of the way I learn is by people asking questions. And what's been great is this podcast has allowed us to get so much more feedback and questions from people. What's exciting is that we actually had someone reach out to us after listening to the podcast, guys. So that was great. We mentioned risk tolerance on a podcast, and they weren't sure what risk tolerance was, or if it's important to know going forward. Completely relevant, especially today, more than ever. Guys, take it away.
Right. I'll go first. Age before beauty, Hammy.
Okay, yeah.
Hi. Actually, no. Just kidding. So,
well, it went beauty before brains, age before beauty, and then back to age before beauty.
I'm already confused. Okay.
You know what? You've got them all.
Yeah.
You've got them all.
So there's, you know, as they say, there's an app for that. There's a program for that. And, you know, we have a great one. It's called Nitrogen. We actually allow people to have access to that from our regular website on somersetwealthstrategies.com. So if you want to take the risk tolerance questionnaire for free, I think that's the simple one. There's a detailed one. If you let us know that you'd like the detailed one, we'll also send that one. It's good to take both of them. Your score may come back differently. So the way that it works is that a 1 is cash, 99 is most stocks, 72 is the S&P 500, and bonds are something in between 1 and 72. So it's incredibly important to understand your risk tolerance. It's one of the most important things because what was that movie? With Jack Nicholson and Tom Cruise, A Few Good Men.
A Few Good Men.
So when Tom Cruise was pressing Jack Nicholson and he said he wants the truth, and Jack Nicholson said, you can't handle the truth. Well, most people can't handle the risk. They think they can, but they can't. And when you are in a more aggressive strategy and your portfolio is invested too heavily, weighted too heavily in equities, and the market pulls back, you need to know how much you can handle. Can you handle 5%? How about 10? How about 15? How about 20? How about 40? So you need to know how much of a downturn in the market that you can handle. In 2022, most recently, full year, before dividends, S&P 500 was down about 20%. And inclusive of dividends, 18 point something, I believe. Back in 2008, it was down 37%. When you freak out, for want of a better way of saying it, when you can't sleep at night, when you're tossing and turning and you sell into weakness, that's called capitulation. You don't want to find yourself in a position of capitulation if you're in good, solid companies, because historically, you can't say it's going to be this way in the future, but historically, the market has always bounced back. And so you need to have a proper asset mix within your portfolio, so that, and that's, we always say stocks and bonds, but there's derivatives of each of those that can mitigate risk. But you need to know what your risk tolerance is. It's incredibly important.
Let me ask you this really quickly, because you said, we do have a risk tolerance questionnaire that everyone can take. It's actually on Annuity FYI at the time of this video being uploaded, so anyone can just go on, take the kind of simple version. It's awesome. But you have 1 to 99, but that's not how most risk tolerance questionnaires work, is it, Tom? You get basically one of 3 words normally. Am I right?
Oh, conservative, moderate and aggressive. But there's also moderate
aggressive,
and moderately aggressive, or moderate growth. So there's usually 5. Okay. I mean, it's kind of like going to the doctor and having a physical. You want to know, you want to have your blood drawn so they can test your blood, so that they know where you're lacking and where you're, where you need, what you need to work on, where you're strong. And then you can treat the areas that you need help with, hopefully through natural supplements and not pharmaceutical drugs. But that's just me. It's a buckets strategy, candidly. What you want to do is divide your portfolio up into buckets. Excuse me, I'm having a little bit of a cold today. But if you divide your portfolio up into buckets based on needs, you can get away from what they call the sequence of returns, which is the market going up and down, and get back to the average returns, because you don't want to have to touch equities and withdraw at a time when the market could be down. Okay.
Can I ask you a question?
Sure.
I have a question.
Fire away, Hammy.
My question would be, in your long and tenured career, have you ever had, because you have this risk tolerance, right? Someone's appetite for risk. I don't know if that phone ringing is showing up in the recording. So anyways, you have someone's risk tolerance, their appetite for risk. Have you ever had to get someone have you ever had to push someone out of their comfort zone, or maybe bring someone back, maybe depending on something like their age or their needs? Have you ever had someone who's maybe in their 80s, they love that stock portfolio, but you just have to have a conversation like, hey, your time horizon's shorter now, or something like that? Have you ever had to, go against it in a certain, to a certain extent?
All the time. I mean, it's just much. We're financial doctors from that perspective, and so just like any good doctor, talking to their patient, we have to talk to our clients in a similar fashion and manner, and you have to have what are sometimes difficult conversations with your clients to make certain that they're doing the right thing. And what you really want to learn is how they behaved in very difficult markets. And you want to know if their needs have changed since the last difficult market. So you don't want to find yourself ever selling into weakness. You want to be able to weather the storms.
Yep.
And you want to make certain that you know your suitability. And we still want to know that the investment is appropriate. And a great place to start is having someone take the risk tolerance questionnaire. And then if they come back as an 85 or a 95, why are you buying a MIGA? So
and the answer may be it's just a piece of their portfolio, right? That's like the bond portion of, or closer to the bond portion of their portfolio. Could that be the answer? But you wouldn't know that unless you know where the rest of the money is, right?
Yep, exactly. That's a great point. You have to look at the full picture. Just because someone is conservative by nature or aggressive by nature doesn't mean that every single one of their individual investments should be individual or conservative or aggressive. It would just maybe round out in the end, maybe more towards that total risk tolerance. But, someone who's more aggressive in nature, has a bigger appetite for risk, should still have some, at least a portion of their portfolio in what we would consider, safe, protected investments. That's just kind of prudent investing.
So how often, Tom, do you think so once someone has taken the risk questionnaire, they've become a client, how often would you recommend they retake the test? They take their temperature, just in using the doctor's, analogy.
Oftentimes it's a lifestyle change or an event. And, it's not necessarily every so many years, but, if you can take the test for free, and you think that something's changed, you feel that something's changed, we recommend that you just take it again and just make certain that you're still in keeping, your portfolio is still in keeping with your risk tolerance. A lot of people, they don't change it, and it needs to be changed. It needs to be adjusted, just like so many other things. Yes,
I also have another
target.
question, or something that might help our audience out. So we've actually had quite a few clients come to us that are fully invested in equities, retiring, or there's a major life change, and you've been able to take that portfolio that was specifically in a brokerage account and really tailor it to their risk tolerance. So is there an example you could give in terms of like a risk tolerance of like someone who's probably right around retirement age, let's say a risk score of 38 to 45, they were originally in equities. What would you do to change that?
Okay, great question. So I think I've referenced this piece more than a couple of times in the past. It's just had a huge impact on me way back in 1999. And it was from the Wall Street Journal, and it's called Playing the Right Retirement Cards. And it was one page, so it's easy to get through. And it was the Monte Carlo simulation theory. And prior to 1999, really just in the 90s, there was a wake-up call. Before the Monte Carlo simulation theory, advisors would literally just say, okay, the market average is 10%, inflation's at 3.5%, my client can take 6.5%, and we can adjust it for inflation. That doesn't work out because of the sequence of returns. I can't emphasize this enough, the importance of this, because if you're invested too conservatively and you wish to take more than, say, 4% from your portfolio and adjust it for inflation annually at retirement, you actually, and I say more than 4, you actually need to have more in equities than you would think, because you need equities are the best hedge against inflation that we have, better than everything, better than real estate. And historically, the inflation hedge is about 8% above inflation on equities. So the bottom line is that you need to know how much you're taking, and you need to understand your investment, your risk tolerance, because there's a crazy number. If you want to take 6% and you have over 20%, 20 years in retirement, which most people do, if you retire at 65, a lot of people are living 85 plus, right? And so you actually need to have like more than 80% of your portfolio in equities, according to the Monte Carlo simulation theory. And that's crazy if you're going to adjust it for inflation every year. So keep that in mind. It's counterintuitive.
Yeah. Yeah. And with risk tolerance, there's these very important things that Tom is talking about, but there's also something, that we have to account for, which is just emotions and things like that, sleepless nights. Conversations around money can be, inherently more emotional than a lot of other kind of topics in life. And that's just because so much rides on money, especially at retirement. If I was a betting person, I would probably sit here and I would say that most, if not all, people have been affected or have relationships affected in some way, shape, or form by money. And it's just important to know what you're prone to, what you can handle, what you can't handle. And there's no shame in not being able to handle a certain amount of risk. Not everyone's life needs to be, that, call it exciting, call it whatever you want.
I call it responsible.
On the edge. You don't have to live on the edge with your money. And it's just, there's no shame in having a lower risk tolerance.
I mean, there is a way
The
to...
tortoise and the hare comes to mind.
Mm-hmm.
Consistency takes the day, So just be consistent in your investment habits, and don't move with the wind, and stay the course, because when you pick a path in your portfolio, again, you don't want to find yourself selling into weakness. There's buy low, sell high, and over 90%, like over 95% of the people get that wrong.
So what I was trying to say earlier, there are ways to participate in equities whilst mitigating risk. We do it all the time. There are oftentimes annuities that you can actually have really strong participation in the S&P and the NASDAQ, things like that, while also having, some sort of downside protection that works. I've seen that work really well with people who are getting older but still want to, still need that hedge against inflation. I know I have an annuity that works that way, and I'm younger, but it works well for me because I can sleep well at night. I don't have to worry about it as much as my brokerage account. So I think that there are, to the point I was trying to make earlier, when someone comes to you and you get their risk score, you're not always going to just say, let's tune up your brokerage account like this. It's going to be a mix of products that it's a collaboration that works best for someone. Is that fair to say?
That's a home run, because
Certainly.
if people, anyone who comes to us, annuities are going to be a part of the recommendation, and for good reason.
Yeah.
RILAs are, there was the Barron's top 100 annuities. RILAs were a big featured piece of that.
Yeah.
And
which is good to see. Oh, a lot of the things that we offer were on there and can help retirees.
For folks listening to this, research RILAs, research structured notes. They're options, but they're options for dummies, and they're options made easy, in other words. And just like going from DOS and computer code to the interface with Macintosh, they're easier to understand. And if you're interested in receiving 100% of the S&P upside, but if the market goes down, there's a product with a 20% dual direction. The S&P could be down 20% over 5 years, and instead of losing 20, you'd make 20. So $1 million, instead of becoming 800,000, becomes 1.2 million. That's incredible.
On a down market?
That is absolutely in a
Yeah.
down market.
Mm-hmm.
Market goes up 100%, you make 100%. And people, the biggest feedback we get on those products are, it sounds too good to be true. How can this be? And you're mitigating the risk of the S&P somewhere between 80 and 90%. Who doesn't want that? Bonds are, riskier than that if in a rising interest rate environment.
Well, this brings something up that I wanted to touch on, because we're talking about, capturing, part of the market, or capturing market returns, but without kind of taking all the risk. Well, some people, a lot of people, they'll say, well, I love my stock portfolio. I don't want to touch it. I want to protect it. I want to keep it safe. Why would I go into something like a fixed index annuity where my upside is capped, even if I can't lose anything? And, to that, I say, great. We love stock portfolios. We all own, stocks here, equities, things like that. Now, the problem becomes, especially when you don't have a paycheck to rely on, what if, if you're sitting there and you're taking income off of that stock portfolio, and then March or April of COVID hits, or a 2008-like event hits, well, now you're selling that same portfolio that you love at pennies on the dollar, and you're selling it to put food on the table, and then the market goes back up and you miss the ride up because you're selling on the way. You're a forced seller in a down market. So that's where something like an annuity, a fixed index annuity, you can use those, to avoid, instead of having to sell your stock portfolio, you utilize that annuity and the stable stream of income, the protected income bucket, that it provides, the safety that it provides. Now you don't have to sell that stock portfolio you love. So you're in a position now where you can protect it because you have other assets that you can draw upon. And then you get to pass that on to your kids with a step up in basis, that sort of thing. So
So it's all about the portfolio and just spreading it out.
Yeah, it's all about
mitigating
the parts of the
risk.
whole. Yeah, and someone could be, call it conservative. No, let's call it a moderate, investor, moderate risk tolerance, and that could be a 50 on our risk scale, which we can get into a little bit. But it might not be everything's 50. It could be an 8. You could have an 80, and you could have a 20, and that's how and that all rounds out to a 50.
So what you're saying, Brian, is that if you are let's say a 48 on the risks, you take your test, you're 48. Not every investment needs to be a 48. It just needs to accumulate to that 48 risk score.
And it shouldn't be, right? Because, especially if you're 60 years old, right? You're going to need money in the stock market in some form or another. Someone might because you just have that time horizon. You need to outpace inflation. I'll give you an example. If someone's conservative, they say, well, if I'm conservative, maybe I shouldn't be in the market at all, right? No, obviously it depends. I'm not going to say a blanket statement, but very, very well could be wrong. We typically view risk as, and most people I would say, view risk as being in the stock market. That's just one type of risk. It's market risk, but there's other types. There's liquidity risk, not having access to your money. Stocks are liquid. Interest rate risk, the risk that your investment or the yield that you're earning on your investment is impacted by future changes in interest rates. Then there's inflationary risk and the risk that your money gets eroded by inflation. And, every year it's going to just get, it's like it's like watching the Grand Canyon get built over time, formed rather. So having no money in the stock market, let's say you're 60, that's inflationary risk. So in that case, you're not really eliminating risk. All you're doing is you're switching out market risk for inflationary risk. And ultimately, if you keep going down that path and you're alive for long enough, there's a much higher chance that you could run out of money. Because your fixed income is just going to get chipped away. So, it's not necessarily about the complete elimination, but you want to just make sure your risk is spread out in multiple areas and thus mitigated. You're protected from all these different areas. So that's something I, wanted to bring up.
It's a lot.
I feel pretty strongly about that.
I got a few things.
You seem
Meg,
very
you were going to say
I'll
something?
step down.
Whew. I need to smoke a cigarette.
You Hamlins know how to talk is all I can say.
All right. So, a few things. Number one, you touched on a number of things, but I would say margin is poison. Don't have margin on your portfolio because if the market goes down, it's a double negative. It just gets worse and worse and worse. It's a negative compounding effect. And so very dangerous. And then at some point you could get what they call a house call. And that's where they take the deed to your house. Ba-dum-bum. Just kidding. But no, you have
Funny,
to sell
not
stocks
funny.
into weakness. You have to sell into weakness. You don't want to be in that position. So stay away from margin. Also, something you're saying, Brian, made me think of like Alaska. If you live in Alaska and you're off the grid, and you're not near a whole bunch of stores and everything, you need to stock up for the winter, right? Okay. So everybody, especially retirees, where you're going to need to access part of your portfolio for income purposes, you need to stock up for the winter. You need to be prepared for bad times, for difficult times, for a down market. And so that, the stocking up in this case is something that's not subject to the volatility and the risk of the markets. So, you want to have ample supplies on hand to make it through the winter, through the bad times.
Yep. Because before you had your paycheck. You had your paycheck
Or you
before.
had your paycheck. You could leave it alone. You didn't have to touch it. Another thing is FIAs, fixed index annuities you talked about. They have zero risk. I mean, we have charts that we can send people, and you can pull them up online too. A 10% cap on the S&P 500 with no fees and no risk beat the S&P 500 over the last 27 years since 1988. It beat it with just a 10% cap. So market goes up 20, you get 10. Market goes up 8, you get 8. Market goes up 10, you get 10. Market goes down 20, you get 0. And that beat the market over that period, exclusive of dividends. So over that 27-year period, you had a 2-point-something% dividend, I believe, maybe less, on the S&P 500. And if you can live off of 2%, God bless you, because that is 20,000 per million, and that 20,000 is pre-tax. So good luck with that. And that's another thing that people need to think about. Most people don't realize how little they can take in retirement, or they're supposed to take. If you're retiring and you have more than a 20, 25-year retirement plan, you're supposed to take 4%, adjust it for inflation. And, that's the Monte Carlo simulation theory. We also have information on all of that we'd be happy to send folks.
Hey, well, let me just ask a quick, Meg, I was
just thinking this. So what he was
saying.
Yeah,
why don't you say it?
Yeah, so what he was saying is, there are retirees who have spent decades accumulating $1 million worth of wealth in their retirement account, and using the 4% scenario, that's $40,000 a year. College graduate pre-tax. A college graduate, I think the statistics were starting out of college $65,000 a year was the average. So someone that's just getting out of school is making $65,000 a year versus saving for decades to get to $1 million. That's a hard pill to swallow.
Yeah, and there's probably some college debt in that $65,000 if they had to go it alone.
Sure.
Yeah. But just the fact that you bust your behind your whole life, raise your family, and then you finally hit that magic million number. You retire, and now your son or daughter is making more money than you. You're right out of school, and you have to live off that for your life. So just
remember, fully fund your 401k if you can. So one question, because I think that we're getting close to the cutoff time, and this has been a really good talk. We might need to have another episode on this. But one thing people might want to know, or the listeners, might want to know, is what can they expect for some questions on the risk questionnaire? Can you give us a guide or a little preview?
So. For the risk questionnaire, ours is, and let me just pull something up right here. So ours works a little bit differently because, I kind of alluded to it earlier in the podcast episode. Normally, most people, they're going to take some quiz and they're going to come out. Mainly there's 3 words: conservative, moderate, aggressive, and you might have some variations. You might have moderate, conservative. You might have moderate, aggressive, things like that. Now, to us, that seems a little bit arbitrary, frankly, because, what the heck does moderate mean? What is moderate? What's the difference between moderate, conservative, and moderate aggressive? Is it just arbitrary? Can you really, tell me and show me? Or, is this just like, a subjective thing? So ours works kind of with numbers, and it's put in the scale of numbers. And that's beneficial because first of all, it allows people to kind of view it differently, in the sense that it's how much you're willing to lose in order for the prospect to gain something over a certain period of time. I'm willing to lose X to gain Y, over the next 6 months. But it's also, where it really all comes together is that your investments, and we didn't explicitly say this, but, I'll say it right now, is your investments in your portfolio are graded on the same exact scale. So you can literally say, I am instead of saying moderate, conservative, aggressive, my risk number is this, between 1 and 99. In all of my individual investments are also on that same 1 to 99 scale, and my whole portfolio as a whole, as a total, is on that 1 to 99 scale. So you can stack up apples to apples, and using numbers, not overly complicated numbers, but just, it's a little bit more specific, a little bit more targeted, a little bit more objective in terms of kind of where you're at.
So what you're saying, go ahead, Tom, go ahead.
No, I just went to the site. Mm-hmm. Go ahead, Meg.
I was just going to say, it's like a would you rather kind of questionnaire. Is that fair to say? Like, would you rather have this or this?
the whole thing
That's-
is would you rather.
So the first question is define a devastating loss, and I plugged in. Okay, it's somebody with $1 million. This is the detailed questionnaire, and I put down $250,000 on the million.
So
it
really
says
quick,
that's
Tom, the
25%.
detailed one is one that you would have to contact us at Annuity
Yeah.
FY to
Yes.
get, correct? So
Correct.
there's an easy one and a detailed one. So Tom's going
And we
through
say
the-
do both.
We
Do it.
put
Try that one out.
the easy one on the site. We prefer the detailed one. The simple one takes about 5 minutes. The detailed one's about twice as long. We just put the simple one on Annuity FYI. It'll be up on the time of this recording, which is wonderful. It'll say, something along the lines of what's my risk number, and it's just a few kind of would you rather questions. Only takes a few minutes. You get back a number, and the question is who would benefit from taking this, right? If someone's watching this. Anyone who hasn't taken one before, especially people at or near retirement, should, take it. I would
heck yeah.
encourage you to.
Just like above a certain age, you get a colonoscopy.
Yeah.
You should
Anyone-
have. You should
This
know
is
your
this is
risk
easier
tolerance.
than that. I'll just tell you that it's easier.
It's-
I think. Right? I'm assuming you don't.
yeah.
That's funny.
Hey,
Good one.
we actually, Tom, we actually want
I
people
like
to
the nap.
actually take the survey.
I appreciate
I
the
don't
nap.
know.
Okay.
Okay, so anyone who has taken one, but it's been a while,
guess.
and Tom, you said particularly after big life events, selling a house, kids move out, begin Medicare, turn on Social
Getting
Security,
married.
Things like that, getting married.
When you're feeling
things-
uncertain, when you just want to know.
Yeah.
Exactly.
Right?
Anyone who feels uneased, feels uncertain about their, an investment, about their portfolio, their plan, if they, feel like maybe they lack a little bit of direction when it comes to, what is this all working towards? You shouldn't have to kind of worry about these things. It just kind of helps to take a quiz and just kind of take those first steps.
Yeah, this is the worst.
and then-
Some people fear going to the doctor. This is not that. This is literally this is just you, dancing like nobody's watching. You get to take this. Nobody's going to see anything. And you get to understand where you're at.
That's about 5 minutes or so.
Yeah.
Yeah.
And then, of course, anyone who's generally kind of curious about this stuff, if you've kind of been able to bear with us for this long.
I like it.
Yeah.
So take the risk questionnaire. There's no commitment. There's no sales pitch there. That's just for your education. However, if you do want to access the more detailed risk questionnaire, you can reach us. You can at annuityfy.com. And you can access us there. You can also do, upload your portfolio, and we can actually, through that, export your risk that your current portfolio has. So a lot of great tools, no commitment. It's just all there for us to help you.
No cost, no obligation. For the quiz, you get your results right away, which is good. And it's right there. It's on the homepage of Annuity FYI. We've all taken one. If you have literally a few minutes to kill, it's a good kind of way to do it, especially if you're
right.
if you're curious. And,
You want to make sure you're on the right path.
Great. Well, Tom, I'm going to leave it up to you. Any parting words for the day?
I was going to say something funny, but maybe not. I just don't think that most people have any indication or idea of where they lie. If you ask most people, where do you lie on a scale of 1 to 10? They usually say I'm about a 5. I'm in the middle. I'm a 6. They don't know. I mean, we get back tests where results where people are a 9 when they thought they were a 5 and a 1 when they thought they were a 5, and so you should not embark on a journey without knowing where you're going and being prepared for the journey. That's what I would say. So this is all part of the preparedness.
Save surprises for your birthday.
There you go.
Not for
Boom, Hammy.
retirement.
Wow, there you go.
There you go.
Yep.
Wow.
Wow. Nobody
Great
likes
parting
surprises
words.
unless it's winning the Powerball.
Yeah, the lottery.
We
Hey,
love
if
that.
it's your birthday and you're watching the podcast, happy birthday.
Yep.
And why are you? I hope you do something really fun today.
Okay.
Besides listen to us talk.
Okay,
I
thank you.
think that's about it. All right. Thanks, guys. I've had a lot of fun today. I learned a lot.
Good one.
Thanks, Meg.
Have
Great
a great one.
question.
Brian, good
Thanks for
job.
bringing the question up.
Yes, that's good.
Don't thank me. Thank the audience. All right. Till next time.
Thank you, audience.
Okay. Thanks. Bye-bye.
That's a wrap on this episode of Conquering Retirement with Annuity FY. Ready to take control of your future? Call 1-866-223-2121 to speak with one of the guests on our show and get your questions answered today. Visit annuityfy.com for more information and to contact us online. Follow the show and make sure to turn on notifications so that you'll never miss a tip, strategy, or breakthrough moment.